Hi,
Hi, Ibrahim.
Ibrahim. So nice to join.
Great to have you. Great to have Ismail. Ismail is my cousin, by the way. Very proud to say that. So far it's only so far it's only us. I hope someone else comes. People are coming.
Hello, Ibrahim. Hello,
Hello,
Arturo.
Felix.
This is Felix from ICEX Alumni. Nice to meet you. Thank you to
Hi,
have you
Felix.
Hi,
here.
very nice
Thank
to
you
meet
for
you
having
too,
us.
Felix.
Thank you for having us.
All right, so we will be waiting for a few minutes. We had, according to what Ruben told me before, we have like 20 people registered. You know, normally there's some people that is missing in the end, but we hope to get at least 10, 12 people. So let's give some minutes before we start.
Great, great. We have a few slides prepared, so we can start talking, and then slides, and then me and Arturo will just go through all the slides together.
Sure. The plan also is, if that's fine with you, I will make a brief introduction about you and also what of Moonbase Capital. Very short, but then in a few minutes, I will just give the floor to you.
Great, great.
I think we have some people in the waiting room, so we have to accept them, Ruben. So yeah, we will be trying to start in 3 minutes at 7:05.
Anyway, Ibrahim, how are you? In Barcelona?
Yes, yes, I'm in Barcelona.
Nice. I was there today, and there was a ferry, a local ferry, an event, and it was very nice.
Weather is nice, huh? I
Yeah,
don't
I mean,
know.
I didn't spend much time on the street, but it was nice. It was nice. One of our big clients was there, and I've been going in the last weeks, almost every week.
Yeah. No, the weather in Barcelona has been so good that you really feel that global warming is a problem because it's like sunny, it's nice.
Yeah,
Madrid,
totally.
Madrid has been, I don't know, it's the same, I guess. Or was it cold? I don't know. You didn't go to Madrid recently, did you?
In Madrid, it's been warm, kind of warm, but I don't think it has been a winter so different to others. I think in terms of raining, we had a few, and next week is also gonna be a bit raining, I think. So normal.
Felix, when do you want to start? We're in no rush. As you see, we are. I think we should wait a bit just to make sure people.
Yes, I think in order to be respectful with your time, we should get going. So maybe let's start if that's fine.
Sure, but I'm also
We're
happy
going
to wait a
to.
few. You don't want to wait a few minutes just because I think now you only have how many?
Yes, we're still 11, so yeah, maybe we can give a few more minutes. Otherwise, we're also recording this session, so it could be, if that's fine with you, it could also be afterwards shared with the rest of the people that registered for this webinar.
Sure. No, of course. Okay. Whenever you want to start, just go ahead. We follow.
Yes. Then I think we can start at least. I can do the introduction, which is the less important thing of today's session. So maybe in these 2 minutes, someone else will also be joining. So well, first of all, thank you, every one of you for being here. At ICEX Alumni, we are the association representing more than 7,000 international trade professionals that perform this Master of Business Administration in International Business. So we have this community that has been running for the last 48 years already, so since 1975. And we have this very big community where we are for whom we are producing this kind of events, this interesting activities from partners that we have from various different sectors in various countries. So today is the turn of Ibrahim and also Arturo, which are today with us. They're going to tell us a little bit more about what search funds are. Maybe most of us, I didn't know much, to be honest, myself, about search funds. I did some little research, but I'm very much interested in knowing more. So we are lucky enough today to have Ibrahim and Arturo with us to let us a little bit more about search funds. But I will let you know a little bit of Ibrahim, so I will introduce him just before giving him the floor. So Ibrahim, he's a renowned investor who joined his father's business at a young age and gained valuable experience on how to manage an SME. He enrolled at INSEAD and finished his first MBA before accepting a consulting position in McKinsey & Company's Milan office. Ibrahim later founded another company that became an industry leader in technology in the Middle East and Africa. He then pursued his second master's degree, this time at the Stanford Graduate School of Business, where the people who invented the search funds concept introduced him to it, giving life to what is now Moonbase Capital. So welcome, Ibrahim.
Thank you, Felix, very much. Thank you for inviting us.
It's a pleasure. Moonbase Capital invests in SMEs through search funds, which is an innovative new asset class which rests on the stability and low risk of private equity, whilst taking learning and inspiration from the agility, diversification, and dynamism of venture capitalists to bring companies bigger to a more consistent returns with lower risks. But then we're also introducing Arturo Alvarez Marcelo Casado, who is an investor with more than 10 years of experience. And after studying industrial engineering, he completed a master's degree in business management. This helped him begin his professional career as an investor in companies such as Elegnor, Lookup Management Consulting, and also Boston Consulting Group. All this experience led him to be manager of Novice Capital. So welcome, Arturo. Novice Capital wants to offer a flexible and attractive transition. Welcome. To current owners, giving them the peace of mind that they will continue and maintain the legacy of their company. So with these introductions made to these two speakers that we have today with us, I give them the floor, and thank you very much for being here. As we said, we are recording this webinar session, so all people who is present right now will be knowing a little bit more about what search funds are, but we will also share that with the rest of the people that registered the community. So thank you for being here, and the floor is yours.
Thank you, Felix. Thank you very much, everyone, for joining. So, search funds is a very interesting concept. Most people never heard of it. So let me tell you why I think this is interesting for people who are looking at the entrepreneurial world or entrepreneurship, because search funds is basically another way of entrepreneurship. It's entrepreneurship through acquisition. So what I do is I invest in entrepreneurs who are searchers. We call them searchers who go look for a company to buy. And Arturo is an entrepreneur who looked for a company to buy and eventually bought. Now he's CEO of a company. So that's how we are going to play this. So I have a few slides that I prepared for everyone, and me and Arturo will take you through it. But it's nice to have there is always three angles for search funds. There is the investor, there is the entrepreneur, and there is the SME, the company. So today you have two of them. Can I share my screen? I don't know if it allows me or not. 1 second.
Yes, if you have any issue, just let us know, and
No,
we
it's
will try to project it.
Can you see my screen now?
Yes.
Okay, great. So, as I was saying, search fund is an alternative route to entrepreneurship. A very interesting one, especially here in Spain, where it's growing really fast. 1 second. It doesn't want to skip. So, in a few words, what's a search fund? A search fund is an innovative way where a group of investors support one entrepreneur, sometimes two entrepreneurs, but one group of entrepreneurs who will do three things. They will search for one SME to acquire. So they spend some time searching for a company to buy. And then they will manage and grow this SME for 3 to 7 years as CEOs, and then eventually sell this SME. Now, the word, what does SME mean? SME is the middle part of any country, any economy. So you have the very small companies and the startups, which here you can see in the chart where venture capitalists invest. And this is where you have the startup world, you have very small companies. And then on the other side, you have the large caps, where you have companies that private equity invest in, where you have the stock market. But then you have this whole middle part, which is small and medium-sized enterprises or businesses. And this is a huge part of Spain and of Europe and of any economy. Usually it's more than half of the economy. But if you think about it, although there is a lot of companies and a lot of activity in this SME section, however, there's not a lot of investment. There's not a lot of things that are moving there. And this is why this search funds is a very innovative way, because suddenly entrepreneurs don't have to do things in startups. They can also be entrepreneurs, but then take an SME and grow it and then eventually sell it. So it opens this door to a new type of entrepreneurship. Now, first thing before we say how it works is what type of companies are these SMEs that we talk about, especially the ones that we as search fund investors invest in. So there is very specific criteria that we look into in order to find these companies. And I will talk about these, but of course the master of this is Arturo, because Arturo spent 2 years looking for a company with these characteristics, and eventually he bought one, and now he's the CEO of a company that he found through the search fund world. So there are some criteria, and please, Arturo, help me or
Yes.
feel free to enter at any point. But one first criteria is the size. So would you agree, Arturo, that the size from 1 to 5 million euros is very important for the search fund world?
I totally agree. Size is the main characteristic. No, yeah, at the end of the day, you need to filter the market and sort of like from 1 to 5 is the sweet spot, no? Obviously, if you think about it, from 1 to 5 is a huge difference, no? Because although we are talking always about SMEs, it's not the same. A 5 million EBITDA that a 1 million EBITDA is 5 times more. But I would say that's kind of like the sweet spot, no? And we can talk a little bit after why we think that size of the company is the right size for search funds.
Another important criteria is what we call recurring revenue, which basically means we look for companies that have contracts that are long-term, so not project-based, but more clients that are buying over and over. This makes it more stable and makes it easier for the transition when you buy a new company.
Yeah.
And then you have, go ahead.
No, I don't know if I can point out a couple of things. No, the recurrent revenue, as you mentioned, it just gives a lot of stability, but it also gives a lot of certainty about future sales. This is important because in search funds, we, the searchers, we don't know which company we're going to buy, which means that we are not going to be experts in the industry that we're going to live in the next 5, 10, 15 years. No. So having this recurring revenue gives a lot of certainty not only to the searchers but also to the investors, such as Ibrahim. And although we've seen very good businesses that are not recurring, very good businesses with high margins, with really good clients, really good products, at the end of the day, our criteria to evaluate these kind of companies, especially when they are really small companies, family companies, that they have a really well position in the market, is very hard to evaluate. So having recurring revenue is something in which you can rely on, something that really help you to say, okay, this is the one company that I want to buy. No?
Yeah. The other very important criteria is high margins. I mean, I guess we only look at companies that are above 15% EBITDA margin, and there is a number of reasons for that. One is it's a cushion, so even if things don't go well, you still have a cushion, so you don't lose money. Another reason why margins is important is to get debt in order to be able to have the bank help finance when you find the company to buy. So having high margins is a very important aspect. And then you have a few others which are a little bit linked. So achievable growth. So the company still has a chance to grow in an industry that's fragmented. So it's not an industry where you have one strong player and everyone's trying to fight it, but it's more an industry with a lot of small, equal-sized players. And then an industry that is growing. So we don't want to invest in an industry that is falling. Because you will sell it in 5 years. So if the industry is growing, when 5 years and 7 years, when you come to sell the company, you have a better chance to sell it. On anything you want to add here, Arturo, or should I continue with?
Yeah, no, I totally agree with the points that you mentioned. Little to add.
And then you have low customer concentration. So it's not you don't buy a company that has 1 or 2 or 3 customers. You want a company that has a lot of small customers. So if one customer falls, it's not very. It's basically is less risky because you cannot lose one customer loss is not a big deal. Simple operations is very important, as Arturo was saying. Most of the people who look for these companies, the searchers, are not experts in the field. So it has to be a company that's simple, not very complex. And then low capex is important because we don't want to keep adding money like the startups where they put round 1, round 2, round 3 and keep adding money. We always want to invest and then have this company grow on its own, which automatically means that most of the companies, if you want to go with low capex, most of the companies are either B2B, so you business to business, so you don't sell to a consumer, but you sell to another business, or services. Many of them are within these 2 categories, either services or B2B, but within very, very wide range of different sectors. And then finally, motivated seller. You have to have a seller who wants to sell. And it's so overall, all this means a company that is already in the market for 10, 20, 30 years, usually a family business that the mother or the father has been managing for a long time, and the kids don't want to join. They don't have a good succession plan because the kids want to do something, pursue a dream somewhere else. So the parents decide to, at the age of 65, you know what, maybe I sell the company, and instead of working Arturo, would you say this is usually what happens is this
Totally.
family transitions, no?
Yes, yes. We've seen Nacho and I, no? Nacho, my business partner, and I, we look for companies for 2.5 years. We've seen, I think we had face-to-face meeting with more than 600. No, at the end of the day, a motivated seller is really important because you can end up losing a lot of time, no, while looking to these companies, and what you need is some kind of trigger that actually makes the seller wants to sell. No, if you look at the rest of the variables that Ibrahim has already told you, as you can see, this is as we would say is the perfect company. No, we're talking about good EBITDA, recurring revenues, high margins, industry tailwinds. So basically, it's kind of like the perfect company. Obviously, I would say that at the end of the day, you cannot have all of these aspects in one company. Maybe you have to play with some of them. You have to balance some of them. Maybe one has a lot of recurring revenue, so maybe you can expect, I don't know, a little bit of customer concentration or whatever. But basically, if the seller doesn't have a reason to sell, a really strong reason to sell, then your biggest competition to buy this company is not other buyer. It's just basically the owner retaining this asset, because this asset is generating cash, is really good, is basically growing, is something that will value more eventually. No, so at the end of the day, the biggest competition that we had when we wanted to buy a company is always the seller keeping the company for another 2 years, for another 3 years, for another 10 years. No, so timing to buy this kind of to close these kind of deals, timing is very, very important. Just as an anecdote, I can tell you that during my 2.5 years of search, we've seen many companies that they were really good, that have almost all of these aspects, and we couldn't buy them. And at the end of the day, some other searcher will buy it. It's not the right time to sell. Why? Because the seller maybe is only 50 or 55. He still has the will to continue in the business, or maybe he wants to try with the son or with the daughter to continue the family business. And if that's the case, they will never sell it, no, because it's a very good company. It has to be a really good company, no, because as you can see in the rest of the factors that we pointed out here, we try to mitigate as much as possible high risks, so low customer concentration, low capex, recurring revenues, all these things, and then you try to ensure that these companies have really good financial standards, no? So it's very
The
hard to
perfect.
find. And then we can also talk about the price, no? But these are small companies. We were talking about the size. We're talking about the small companies that maybe they are not still in the radar of big funds. But you also don't want to overpay for these kind of companies, no? So
Yeah. Let's go to this detail. So basically, so far we know it's a way to invest in these SMEs with very specific criteria. The question is, how do we get this? How do we get these SMEs, and how does this journey go? So this small drawing is basically Arturo. So Arturo started off. The first thing is, can you tell us a bit about why did you decide to do a search fund, and 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 the first steps of doing a search fund? Because I guess first is search fund, and then you go to different investors to talk to investors in the beginning when you still don't have a company, you don't have anything. Can you give us a few words on that?
yeah, so basically, there's two type of searchers. No, I would say it's the solo searchers, so people that do it alone, or people that do it in duos. There are some trios, but typically is duos or solos. No, I did it with my business partner, as mentioned before, Nacho. We were both working in consulting for 5 years together. Then we did both the INSEAD MBA. We work very well together, no, Nacho and I. And we always envision at some point we always wanted to be entrepreneurs, but sometimes it's hard to be an entrepreneur, no. And I think, Ibrahim, you made a very good point before, no. Entrepreneur doesn't mean to have a startup. Startup is one way of doing entrepreneurship, but it's not the only way. There's so many different ways of being an entrepreneur, no. So we wanted to be an entrepreneur, but we didn't know how, when. We didn't have the idea, and also maybe we didn't have the courage, no. So we did the INSEAD MBA, and at the INSEAD MBA we had a professor, and we had a course that talked about this kind of entrepreneurial through acquisition, which is basically search fund. No, it doesn't need to be a search fund, but entrepreneur through acquisition, and we kind of like it, but we thought it was, to be honest, no, in our case, we thought it was too good to be true. Okay, so some investors are gonna back us to actually find a company, and then we're gonna become the CEOs of that company. Wow, it's an amazing. No? So we went back to consulting. Nacho went to Bain and Company. I was at BCG. We were working a lot, and then the COVID came. Nacho in Bain had 3 different colleagues from the same Madrid office that went to do the search fund model. So then we started to think, well, maybe this is not too good to be true. Maybe we can do it, no? And we looked deeply to the model, and we loved it. We loved it for different reasons, but basically it has the finance part that we like, it has the consulting part and the strategy plan that we like, and then it has the entrepreneurial part, no, and the managing things that we were really missing from our consulting lives, and that we really wanted to do it, no, and we said,
Great.
okay, let's do it, and then we talked to a few of the search fund investors here in Spain. The community is huge, and they mentioned that if we went ahead, they will give us finance, no.
So the first step you do is you talk to a bunch of search fund investors like us. Moonbase is a search fund investor, and how many search fund investors usually do you have? Not maybe you specifically, Nobis, but in general.
I think in general, most search funds would talk between 30 and 60 at least, because you typically a search fund has between 10 and 20 investors, and yeah, you need to talk around between 30 and 60 different investors, no?
So the first step is you talk to 30 and to 60 investors, and all you tell them is, here is my CV, or we call it PPM, which is just a detail of what you will do. And you talk to 60 investors, and then eventually you convince 10, 20 of them to each give you a little bit of money. So you can combine a budget, which is a fund, small fund, to search for a company. This fund only role is to do the next step, which is to go out and look for SMEs over 2 years. So you collect, let's say, around 400,000 euros or 500,000 euros, and this money you take and you spend over 2 years in order to look for a company to buy. Can you tell us a bit, Arturo, about these 2 years of looking to a company? How many SMEs do you send to? Is it easy? Is it hard? How do you interact with investors? Can you give us a bit of flavor over these 2 years of looking for a company?
Yeah. So once you raise the capital, then you need to obviously do all the bureaucratic things that you need to do to build the company, your company. But basically, after that, what you do is you go out to the street and you start looking for SMEs to buy one, no? So it's very overwhelming at some point. It's hard because you obviously you have little criteria to not only to choose the good and the bad companies, uh, but you need to build the that feeling, that intuition, because the matter here is you have a little bit of capital, and that capital, basically what you're doing is buying time. So time is the most precious resource that you have, no? So you cannot lose time. You need to talk to everybody, but you have to do it fast, but not too fast, because if you are going too aggressive with some owners, you're never going to get their trust. So you need to build that sense. For example, we in Novice Capital, we started the first month. We started with some industries that we thought they were not the best industries. So we didn't burn too many leads, but we actually gained a little bit of experience. No? So we started with things like agriculture or things like that, which actually have really good leads too, buy really good companies to buy, but probably only 1 out of 20. Instead, if you go to software, maybe it's 5 out of 20 or something like that. No, so you say, okay, and then you build your speech. No, you have to put yourself on the shoes of the seller. You have to understand a little bit the ecosystem. typically very small companies from 1 or 2 million EBITDA. Maybe the seller is not very sophisticated. Maybe they have a little bit of advisors, but very local advisors, also not very well, not very professional or not very well trained. So you have to develop that skill. No, if you want to buy a company, you cannot go there and say, okay, I want to buy you, I want to buy you, because then every time you speak, the price goes up, or the possibility just. So you need to be analytical, but and try to filter a lot of companies. It's hard. You work with very huge databases. At the end of the day, the secret for me is to filter as much as possible those databases, but not filter too much, because you never know where you can find the company you want to buy. So because you cannot filter too much, then again, what you need to do is be, I would say, try to balance very well between the time you spend with one company and the knowledge you need to have from that company to actually keep negotiating with the company or just forget about it. Sorry,
Perfect.
we have a question here from Joaquin Fernandez de Pirola. But,
Go ahead. Go ahead, Joaquin.
okay. How did you build up the deal flow? Okay. Well, the deal flow, how did you build it? Yeah, you need to start, cold calling companies. You need to start building your network and talking to everybody about companies, and then you start building your deal flow. It takes a little bit of time, but once you have a little bit of momentum, then you just keep the deal flow. The problem is the time. Again, the problem is not to build the deal flow, is the quality and the time that you spend on your deal flow. So you can look at so many companies per week, but are they good? Are you progressing really well with them? That's the key question. No? How do you balance?
Perfect. And then finally, you found one company that you liked, and you went ahead to close this deal. And lucky for me as well, we closed the deal, and now you're the CEO of this company. Can you talk us a bit about closing the deal? How is it? What is the role with the banks? And also, how easy was it to get all the investors? Because you have a lot of investors. How easy is it to make sure that everyone is aligned and you close the deal on time?
Okay. Yeah. So first, I would say that you need to play with many different companies at the same time. Again, you need to balance, no? So you are progressing. So the deal flow starts with leads and end up with the deal. Only one company is gonna be your company, but you need to have that funnel very well fed. Uh, at Even at the last day. So we were signing the deal and we were still having deal flow, because you never know when you're gonna sign. These are very volatile decisions, especially for the
Yeah.
sellers. And so it's very stressful. In our case, it took us a year and a half to actually sign the deal. It doesn't mean that we spent 1 year and a half only with this company. No, again, we were feeding the funnel, the deal went off and then went on again. It happened to us many times with many different companies. We could have end up buying some other companies. We had a lot of LOIs, etc. But yeah, the closing phase of the search fund is tough, because you have a lot of, let's say, emotional pressure to close the deal because you really like the company, but if it falls, you need to start over again, no?
Yeah.
Then you have to manage very well the sellers, so you need to build the trust with them, but at the same time, you need to do the due diligence. Okay, you're going to be doing a due diligence probably with some nice advisors, but the commercial due diligence, you have to do it yourself. And the strong due diligence, you need to do it yourself too, no? So, okay, you are building trust with the seller, but at the same time, you need to ask tough questions to the seller, and you need to point out the things that you don't like, because otherwise the pricing of the asset are going up and down depending on the answers, no? And you need to analyze all the data. So first is the sellers. Okay, you need to keep them happy somehow, but not too happy, no?
Yeah, exactly.
You need to keep them happy and and motivated to sell, but you know that there's competition, and you don't want to overpay, you don't want to be too nice to them, no? Then you need to manage also the banks and the investors, which are the ones putting the money, no? And then, okay, let's talk about a little bit about the banks. Basically, you have to talk to all the banks. You want to do a little bit of a leverage buyout, so you're gonna lever a little bit. You're gonna use some leverage to buy the company. Always the suggestion is again not to lever too much, not to leverage too much, because we want to avoid risks. Again, think that two entrepreneur guys of around 30, 35 years old are going to buy in a company in a industry or in a sector that they don't know. So we are not experts. So you shouldn't leverage that much, because now you're going to become the CEO of the company. It's not like a PE fund that is going to buy 50, 70% of the company, but the founders, they still in the company, or at least they hire a new CEO that comes from the industry. So here the risks are a bit bigger. So you need to be careful with the debt. And here, the good thing about Spain, that I don't think it happens in many other geographies, I think it's becoming more and more usual in other geographies, but in Spain, we have a really good track record in search funds. We have a lot of deals that have been closed in search funds. So this means that when you are going to talk with the banks, especially 2 or 3 banks, are already really familiar with search funds, and they have really good stakeholders to talk with search funds. So you talk to 2 or 3 of the main banks. We try to talk to many others, because the more competition, the better the pricing is going to be. But the good thing is that, no, that the lawyers from the banks, lawyers from the search funds, the bankers, everything is very well already kind of like organized. So a lot of work has been done by some of my colleagues previously. So here, what you need to do is just basically do your business line, do very well your job in terms of analytics and slides and Excel files and all these things, and then just try to compete to get the best price and the best conditions. That's about the banks,
Yeah.
no? And then about
Yeah.
the investors, it's a little bit similar but different, no? In the sense that again, you probably have a bunch of investors that have put you capital from the very beginning, no? And here in the slide you can see it, but that doesn't mean those investors, they don't have the obligation to go to the deal. They have not committed to go 100% to the deal. They can go, they have the option to go to the deal, but it's not mandatory for them. So what happens typically is that for whatever reason, there tends to be a little bit of gap. So you have to convince your investors, and probably you have to bring also some new investors. That's very typical, no? But at the end of the day, what you have to bear in mind is that you need to convince the investors. Sometimes they are harder to convince than the banks, because the banks obviously have a different risk scheme. And what typically investors are looking are for the things that Ibrahim told us before, no? So is the company good? Has the seller a reason to sell? Is recurrent? Has high margins? The industry is nice. The product is good. What are the main risks, no? So search fund investors are, I would say, they are very supporters of the searchers, but also there's a model that works, and typically investors, they tend to look very careful to that model, no? And for obvious reasons. So the company needs to be good, the asset needs to be good, and also I think that the searchers need to gain the trust of the investors along the way, along the search phase and along the deal closing, no?
That's a
And
very
for
good
us,
point.
that was tough. Then we can talk about different investors. Obviously, within the search fund community, not all investors are exactly the same. Some investors, they put their own money. Some others, they are funds. Some others, they are big. Some others, they are small. So you have to manage that kind of things also while you do the fundraising for the deal.
This is a very good point. It's a very good point. Is that during the 2 years when you're looking for a company, you get closer to many of the investors, and you need to make sure that they trust you and they get mentally ready. So when you find the company, they are ready to invest with you. So that's a great point. Thanks for bringing that up. The other point that you brought up, which is very interesting, is how many times it happens that someone loses the deal 2 3 weeks before closing. So many cases where people think they already closed, but then finally something happens and it doesn't close. So it's important to always keep the deal flow alive, the pipeline, even if you think you already closed. But that's it. I mean, that's the way it works. So it's basically, just to summarize quickly, you start as an entrepreneur, one or two entrepreneurs, you go to investors, you convince them that you have the ability to look for a company to buy, and then you spend 2 years. They help you a bit, but you do the job of looking for a lot of SMEs, thousands, until you find one you like. Eventually, you go to the bank, you get half of the money from the bank, the other half from investors, and then you become the CEO of this one company and you run it for 5 years, 6 years, and then eventually you exit. Now, this model has started at Stanford back in the 80s, and Stanford does a report every 2 years to measure the search fund the returns. And as you can see, the return from search fund investing over the last 30 years was on average around 30% annual return, IRR, annual return, which is more than venture capital, more than private equity, and more than the stock market. So, of course, to be also fair, private equity and venture capital and stock market are much bigger asset classes. They're in the billions and trillions. If you talk about private equity or S&Ps, in the trillions. So it's not so fair to compare apples to apples because search funds is a much smaller asset class. However, it's growing very fast. Spain is second or third country in the world in terms of search funds, and the return is really high. So overall, it's a very good asset class. And the beauty about it is that in order to get this return, you as an entrepreneur don't need to do the same results that you need to do as a startup entrepreneur. Startup entrepreneur, you need to do a unicorn, you need to take a company and beat everyone else and grow it by a lot. In the search fund world, if you as an SME owner, an SME, a search fund, a searcher, if you're able to maintain the growth of the company at 8, 10% only, so you don't have to grow very fast, but you maintain this growth 8, 10%, and then you pay off all the debt, which is not easy. As Arturo was saying, you need to make sure that the company is running healthy, expenses are all managed, so you can pay off the debt over 5 years. And naturally, when you grow the company, the EBITDA multiple. So EBITDA multiple is the determinant of the price. So let's say, for example, when you buy a company that is at 2 million euros EBITDA, you could agree on, let's say, a multiple of 6 times EBITDA, which means 2 times 6. So the company value is 12 million euros. So that's when you grow this company from 2 million EBITDA to, let's say, 3 or 4 or 5. When you go to 5 million euros EBITDA, many more people want to buy it. So it's normal for the EBITDA multiple to grow from 6 times to, let's say, 7 times. So now you bought the company for, let's say, 2 million euros times 6. So it's 2 times 6 is 12 million euros. You got from the bank 6 million and you got from the investors the other 6, let's assume. So you paid 6 million for it. And then you grow it to 5 million euros EBITDA, and now it's 7 times EBITDA multiple. Let's assume it can go more, but let's say 7 times because private equity wants to buy it or whatever. So now it's 5 times 7, so it's 35 million euros what you sell for. Now, if you remember, we said we bought it for only 6 because the bank paid half, and now the bank took its money. So the return from 6 million euros that you got from investors to buy this company into selling it for 35 in 5 years. So that's why the return is so high in search funds, and it's a return that's not as risky and not as hard to do. Of course, it's very hard. Nobody makes money easy, but it's not the same style of growth and risk that you see in startups, where maybe 1 out of every 20 would really succeed. Here, maybe if you find a company and you run it, maybe 8 out of every 10 will succeed. So it's a much easier or a much better probability of success. Would you like to add something, Arturo, about the returns or the IRR?
No, I think that you pointed out the key parts. No, I have little to add. I think that the returns have been really good so far. We hope that those levels of returns continue like that, obviously. And I think that the key part is just that at the end of the day, you have two or one very well incentivized entrepreneurs that want to buy a small company that is not in the radar of the big funds, and but that has huge potential. No, so as you were mentioning, is not you are not buying an idea like in the startups. No, you're not buying some kind of change of paradigm in the market. You're just buying a good business, and you just want to grow it a little bit. No, um, and that's why I think the risks are not so high. At the end of the day, the returns are really good. No.
Yep. So that's it for the presentation we have. But let's open now for the last 50 minutes for any questions you may have. I know the search fund world or the search fund story is a bit confusing. So if anyone has questions, anyone is confused, please feel free to ask us.
There's a question here from Nancy. Uh, she says, no, how easy or difficult would it be for non-Spaniards to engage in this process from both financing and deal sourcing perspective?
Would be hard. I would say it would be hard. I mean, I think if I don't know, Arturo, what you think. I think if you're good in Spanish, if you're South American, if you're very fluent. I mean, I'm investing in searchers who are South Americans. I mean, they're not Spanish per se, but I think if you don't speak fluent Spanish, would you be able to find the company, Arturo, if you're not?
I think it's possible. I just think it's harder. So we know one searcher. He was from Austria. He spoke very well Spanish because he used to live in, I think, Argentina or Chile. She wasn't native. I would say his Spanish was good, but not perfect. So 100% is going to be tougher for him to gain trust with some family business owner, no? And we are not talking about very big companies, very sophisticated companies, no? So at the end of the day, most of the people we've met in the last couple of years, they were people that built their business from scratch in 20, 25 years. Most of them, they didn't went to college or to university. So these people need that kind of confidence. They need to feel that they are talking to someone similar to them. So I would say it's harder. If you don't speak Spanish, it's very tough in Spain. People don't speak English, and even if you're Latin America, we were speaking to some other searchers a couple of weeks ago. They wanted to start a search fund in Spain. We've seen people from Latin America that have search funds in Spain, very successful search funds. I would say is still tough, still a bit tougher. Ideally, if you look for companies in Spain, you will be Spanish. If you look for companies in Portugal, you will be Portuguese or have a partner that is Portuguese or have family in Portugal. I don't know. Something like that is important also because most of the conversations you talk to the owners is not only about business, but also about things you like, things like that. So sometimes it's easier if you're Spanish, but not impossible.
Ignacio has also a good question, which is, we mentioned that search fund SMEs in all verticals. What are the most common sectors to found this type of companies? I love this question. I love the question because, Ignacio, you would not imagine how diversified it is when it comes to sectors. Like for me, every time I talk to a searcher who found a company and wants to talk to me about it, for me, when he's still explaining before he starts, my mind is, where will he take me? Because it can be anything from, it's really wide. So you have a lot of software. You have a lot of, what's Arturo? What I think a software I'd say would be the most. If something is repetitive, I'd say software
Yeah,
comes the most.
yeah. I think if you look at the criteria of the SMEs that you want to buy, at the end of the day, software uh, goes very well with all the things we look. No? So software typically is recurrent, typically generates a lot of cash, and typically whenever they have certain amount of business, they become really good margin businesses. No, so I think software is the one industry that stands out from the rest, no? So I don't know how much, but 10, 20,
Other
30% of the businesses that the search firms buy, they have some kind of software, which is a lot because then the rest is so spread that is
so
very
spread.
hard.
It's so spread. I mean, I'm talking about from tool sharpening. So I'll tell you just our investments. So we have one that is doing tool sharpening. So if you're a factory and you have, the tools, you need to go and sharpen it. So it's just a company that does tool sharpening. And then there is another company that does websites and does SEO for very small bakeries, plumbers, etc. And then there is one that does um, waste management, very regular waste management, for example. And then there is another one that does. Arturo, you can tell us a bit also about the company you bought, which is.
Yeah, we were a company that manufactures laser devices for aesthetical purposes, basically for hair removal devices. So I don't think there's many other
No, very
searchers in the world
random.
that have
Look
bought
at
something like that.
the spectrum when it comes to these SMEs is really,
Education, we
really
look
wide.
a lot of companies in the education sector also because it has really good working capital, but also in agriculture, also
Health is
in
always a good one. There is a lot of things related to
very
health
expensive but
somehow.
really good.
Yeah.
I don't know. Yeah, it's very rare. At the end of the day, you don't know where you're gonna buy one company. You probably it's easier to mention where you are not going to buy a company. So, for example, when we were building the network to look for companies, and we talked to a few brokers, and they say, "What are you looking for?" You say almost for anything, no, but good companies. And then you say, "Okay, I'm not going to buy something with real estate." No, because at the end of the day, it's not the business. You're not going to buy something that is in construction, so nothing in infrastructure like renewable energies, investment, heavy investments, things like that. You're not going to
And,
invest
and,
there.
and I think also most B2C goes out. Most B2C, because
Yeah, B2C. Yeah.
if you sell to a consumer, you need distribution to grow. You need distribution, you need working capital, there's a lot of things you need to invest in order to grow. So usually B2C. I mean, if you look at the services and if you look at B2B, then it's really, really wide. Ignacio is coming up with another question, which is how does interest rates, the fact that interest rates went up, how much does it affect this type of investment? I mean, it didn't affect much. I tell you why, because of course the company has to be able to pay back the debt. So the debt payment is a bit higher. But if you do the numbers, I would say the effect is not that high that it ruins the model, basically. Arturo, what would you add to that?
I,
What
I,
would
I
you?
totally agree. I just think we don't leverage that much. It's just that the debt is a bit more expensive, but debt here is not the key.
Yeah, I mean the
It's
cost of debt
important, but it's not key. Yeah, it might
and the
be more
cost.
important for other kind of buyers that go more leveraged, but not us.
Exactly, exactly. Any other?
Yeah, hello, Ibrahim and Arturo. Thank you very much for the interesting talk. I was wondering, I mean, once you become a searcher like Arturo and you spend a couple of years getting really specialized, in analyzing companies and getting the process, on getting this deal flow that obviously you need some sort of art and as well in negotiating and identifying and closing. I was wondering why not to repeat it, and to have two, three companies. If you are probably one person, no, but if you are a duo, you're a trio, probably you can grow, this group, putting people of your trust to run the companies or to help you run the companies, and you be on the top of it, doing more deals once you have become an expert, no? Because, I mean, just to put you on the freezer for another 5 years and then start again in 5 years' time, it seems a bit unproductive, no? Once you have become really an expert doing the search. I don't know, how do you feel about that? First as searcher,
Yeah,
and as well
yeah, no,
as search
I,
fund. No?
I think that the key part here is that you, for example, I'm going to talk about me and Nacho. We are not deal makers. We don't work in the M&A industry. We like the finance part, but we're not expert in that neither. So at the end of the day, you want to become an entrepreneur. You want to become empresario. And that's the key part of this thing. I think that's the key part of the model. Two guys that want to have a company for their own, and because they don't have the money to buy it themselves, or because they don't have the time to start from scratch, then they up ending with a search fund, which is sort of like an easy way to manage your own company. But the key part is that you need to be motivated to be the CEO of a company. Without that part, I don't think that the model loses something. That's why
Yeah,
one of the one of the clauses of the shareholder agreement with investors is we have exclusivity for this company that we buy. We cannot buy anything else. We cannot do anything else. We cannot work anywhere. We put all the eggs in one basket, and that's part of the model. It's true that some people think, oh, what a waste of time, no? Because for 2 years and a half, you built such a good network and such a good deal flow. Yeah, but the purpose was very clear, just to buy one company. And with the rest of the deal flow, you can do things, no? Some searchers, they talk to other searchers. Hey, I buy my company. Do you want my deal flow? Hey, I have a couple of companies that might end up selling in 1 year. So here is the lead or whatever. But that's not our business. The business is to pick one company and then work very, very hard on that company, only in that
I,
company.
I agree. I mean, also as investors, I wouldn't give money to someone who will look for a company and then find that. Also because it's hard to find a good CEO for such a small company. I mean, Arturo would not, with his CV, he would not work as a CEO of a small company, but because he's an entrepreneur and he has a chance to take shares, etc., he would do this. So you have a very good CEO that usually would not do an SME, doing it as an entrepreneur with the. But to answer you, Joaquin, what happens in many cases is they grow through M&A. So in many cases, when they buy this one company, they would use this company to buy 3, 4 other companies over this 5 years in order to grow. But it's in the same field, it's in the same, so you grow through M&A. So this happens a lot, and this is, you're right. You use the fact that you already got used to deal making and banks, etc. And then once you're a CEO of this company, you then buy another one, another one, another one, but the same field, and then you grow
Or
till you exit.
That makes sense.
Ibrahim, I met other search firms that they do some they have a bit more flexibility. Depends on what is your target. Maybe you can buy a small company. No, we were talking about companies from 1 to 5 million EBITDA. If you are a duo, maybe you can buy two companies of 1 and 1 million EBITDA. Or I saw some searchers that they do a different kind of search fund in which maybe they buy a portfolio of companies, very small companies, but it's hard for them to manage more than one company. And then also after 1, 2, 3, 4, 5 years, if you feel like you can spend more time in some other company, you can talk to your investors, and maybe you can ask for more time to do something else. But it's hard because also you have one thing you have to keep in mind is that investors, they put money in the searcher and the company combined. That's the bet, no? That's the investment. So if you buy another company, it might happen that these investors, they like the searcher and this company, but they don't like this other company. So what are you going to bring? You're going to bring new investors. So then there's a little bit of interference between the two things, no? Because then you have CEOs with one investors here and other investors here. Then the model doesn't work that much, no? Because we need to be fully responsible and fully committed to the company, no?
Nancy has actually another question. Can you do this to start the search as a part-time? And I think no way. I mean, it's really the thing with searching is I think it's really hard. You're an expert in that, Arturo. Maybe you can say more, but I really don't think it's a
No,
possibility.
totally. I mean, impossible. The search phase is 100%. Either you're searching or not. I have friends and they always tell me, hey, now that you've been looking to so many businesses, maybe you can tell me one or two. I say, yeah, first say no to your job, then put all the eggs in one basket, and then start working 12 hours a day only looking for one company, because otherwise you lose credibility, no? When you go talk to an owner, to a seller. Then you're gonna say, no, I'm working part-time here, but I can also buy your company. No, they need they need to see the commitment, no, and also investors. I would say that you need to say bye-bye to your job while you're doing the first capital raise. And maybe Ibrahim has more experience than I have, no, but the first thing we talk, Nacho and I, is okay, if we're gonna do this, okay, we have to say, we have to, I mean, like, get out of our jobs, and they were very, very good jobs, because you need to do this, no, and you need to go
I
for it.
think I think what you
Quick
can do
follow-up.
is go ahead.
I was just going to ask really quickly, do you find, was there anything you wish you had done in terms of preparation before you made the full-time switch?
No, no. I mean, you can always do more. You can always do more, but I
No,
mean,
but
if
I think
no, I mean, I was working 16 hours a day, so I didn't have any more time to do anything. But if you have an easy job, I would say, okay, yeah, I don't know, try to build some nice model, try to talk. Mira, what I would do
exactly,
is to
exactly.
talk to a lot of investors and a lot of search funds and a lot of business owners. Just talk, 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 talk.
Exactly. And this you can do while you're working. So if I would give you advice on that, Nancy, is you can start talking to a lot of investors like Arturo, entrepreneurs like Arturo, and talk to investors like Moonbase and others, and talk to some companies, and just try to see if this is something you like, and ask them, is my profile would be good, would you guys invest with me as investors? You ask more about the job, how this you can do as a part-time thing. You start talking to even investors and see if you will be able to find the investment or not. But once you have investors that tell you, yeah, we're happy to invest with you, then you stop, and then you will take a salary from these 2 years. You will have a salary because these 2 years you are looking for the company, and you have a salary from this search fund for the first 2 years, and then eventually. So I would say maybe part-time until you find the investors, and until you decide that's what you want to do. But if you're actually searching for a company, no, I think it has to be full-time.
I agree.
Great, great. Thank you, everyone, for. Someone has a very quick last question, but we're already over time. So I think, Felix, back to you.
Yes, thank you, Raheem. If there's any other question, now's the time. Otherwise, I will also make one very last question that I think could be relevant to all of us, also our community. So, any other question? No? Okay, then I will go ahead. Well, you have presented, I mean, it's been a very, very, very interesting presentation. I think we have all learned a lot about what search funds are, what's the purpose, what's also, as Arturo mentioned, it is about becoming an entrepreneur, becoming an empresario, right? So it's a different way of doing it. So you also presented that at the beginning, Ibrahim. But Arturo also mentioned that as a search fund entrepreneur, as a searcher, he was looking for capital funds that would trust his project. But my question is to you, Ibrahim, do investors also look for searchers? And if they do, how they do it?
There is one website which is called searchfunder.com. So this searchfunder.com is one way to also look for searchers. But the beautiful thing about the search fund world is that it's very close, and people are talking a lot, and they're all very friendly. So you don't really need to. I mean, if Nancy, for example, decides to do that, and she reaches out to different searchers, maybe she goes to searchfunder.com and finds a few searchers out there, and she sends them an email, hey, I want to talk to you. Most of them will talk to her, and most of them will give her advice. And then the same with the investors. It's not very competitive and shrewd industry like private equity, for example. It's more because we all invest together. I mean, anyways, each investor takes a small portion, so in the end we all work together, we all help each other. So yeah, I mean, many cases they come to us because they talk to others in the industry, and they find that we want to work with Moonbase, and then they call us, and they go to the website, etc. But I think on LinkedIn and on searchfunder.com, there is a lot of leads.
All right, thank you very much. So maybe just one last thing. Given the fact that search funds are not, not many people know about them. Is there any kind of mentorship or training for people that would like to know more, or yes, maybe thinking of starting to be a searcher?
Usually it comes in the MBA programs, and that's also why we think it's nice to talk with you guys about it. So usually people learn about it in the MBAs. So usually the top MBAs usually have a search fund program. So ICEX is very big at that, for example. ICEX has a big program, INSEAD has a big program, Chicago Booth, Harvard, Stanford. So I guess if you as a group want to have a lot of people who are interested, then we can think of a way to get more people who know and talk about it for a smaller group who wants that. So maybe if that's the case, we can put something together for you guys specifically. But I don't think there is anything. Arturo, is there anything you heard of, like a training or something?
No. I think maybe outside of this ecosystem, maybe people don't know much about search funds, but it's an asset class that is growing and growing. And the other day they called me from The Economist. They are putting this information in many places, and I think a lot of people now know about search funds. I don't think that people don't know, because if you are talking to any investors, PE funds, ventures, banks, everybody knows about search fund now, especially in Spain. But in 5-10 years, it's going to become very, very, very popular. It's going to become like startups, not maybe like startups, but it's going to become something that everybody knows.
I mean, 20 years ago when I did my MBA at INSEAD, to do a startup was very rare. Today it was very rare. I mean, most people did either consulting or finance. Now, I think the number is 25% of people who do MBAs do a startup after 2 years. 25%, a quarter of them. So it's huge.
Yeah.
And this is only like 10, 20 years. So it really flew. So I agree with Arturo. I think in the next years, search funds will be more and more a common way of doing entrepreneurship, and it will be, everyone will know it.
It definitely sounds as a very interesting opportunity to an alternative way of doing entrepreneurship. So we will keep an eye on these search funds for our community. For those who don't know about it yet, we will continue, disseminating some information about that. We will also try to test if there is additional interest about this, so that we can work on something else in the future. So. With that being said, thank you very much, Ibrahim. Thank you very much, Arturo. And let's stay in touch.
Thank you very much. Thank you for having us. Thank you, everyone.
Thank you, everybody.
Ciao.
Bye-bye.
Bye, everyone. Bye.